All right, dear students, in this lecture, we are going to discuss how to close the ledger or the T account. If you remember the last lecture, we discussed how to make the T account. So we were actually making the T accounts in the last lecture. Now we are going to understand how we will be closing these T accounts or the ledgers. Now, the first thing you need to understand is why we will be closing the T accounts or the ledger. Obviously, there is a reason behind that. The reason is that we studied the accounting cycle. Now, the accounting cycle suggests that first of all, we have the business transactions, and then we pass the journal entries, which means the double entries. After passing the journal entries, we post those entries into the ledger or the T account, and then we make the trial balance. And after making the trial balance, so the last step is making the financial statements or the final accounts. I told you that this is the most simplest form of accounting cycle, because you may see some extended version of it in some other books or some other channels. Now, what they have done is they have actually segregated each step into further steps, divided each step into further steps. But if you talk about the most simple and most realistic accounting cycle, this is right in front of you. You have the transactions, you just pass the double entries, then you put the ledger, you put those entries into the ledger, then you make the trial balance, and then you have the financial statements. Now, because we have to make the trial balance from the ledgers, that is why there is a reason that we have to close those ledgers or we have to balance off those ledgers. Now, this is fairly a simple concept you need to understand. So these are the principles that we will be understanding, that how to close the ledger or the T accounts. So the first step is total both debit and credit side and see which one is the larger total. Now you have an example right in front of you. If you see there is a bank account, and then you see these three transactions. Interest income has been received in your bank account because it is on the debit side. Then you have done the purchases from your bank account because it is on the credit side. And you also paid a telephone bill from your bank account, which is on the credit side. So you have done three transactions from your bank account. You did the purchases, you paid for the telephone bill, and then you received interest income in your bank account. So three transactions. Now, if you're wondering what this closing balance is, I'll be telling you in a while. So you have three transactions in your bank account, and the first principle was total both debit and credit side and see which one is the larger total. So you have two transactions on the credit side, and the amount is 5,000 and 40. And on the other side, you have only 150. So the larger side in this example is the credit side, which makes the total 5040. Now the second step is post the bigger amount on both the debit and the credit side. So because this 5040 was the bigger amount, so we actually put this amount both on the debit and the credit side. Now the third step is insert the balancing figure on the lesser side. So if you see realistically, we have put the 5040 here, but we have only one transaction, which is 150. This side is quite less. That means there will be a balancing figure, which is known as the closing balance. Now simply, what we did is we actually received 150 in our bank account, which is on the debit side, and we paid 5,000 for purchases, and we also paid for telephone expense. Now what is the remaining thing is actually 4890, which is actually the closing balance. We are actually making the ledger balance. So this closing balance represents the balancing figure which is coming right in front of you. Now in this account, this closing balance is coming on the debit side. Maybe in the next example, when you see, this closing balance may come on the credit side. It's fine, this is normal. Either it will be coming on the debit side or either it will be coming on the credit side. But the thing you need to remember that if the balance is written on the debit side, it is actually a credit balance and then vice versa. Now you see this closing balance is coming on the credit side, debit side. This is the debit side and this is the credit side. This closing balance is coming on the debit side. Now this represents actually a credit balance. Similarly, if it is coming on the credit side, it represents a debit balance. Now, what is the logic behind that? Remember one thing, that when you are talking about any account, say for example, you are talking about non-current asset. Now, non-current asset means that we remember that usually when we have the assets has the opening balances which comes on the debit side, because we have a mnemonic which is dead click. Now that D stands for debit, E stands for expense, A stands for asset, and D stands for drawings. So when we are talking about the assets, the opening balances are normally going to be on the debit side. So let's say this is the opening balance. And obviously when the opening balance is coming on the debit side, the closing balance is going to be on the credit side. Like see now this closing balance is coming on the credit side, but actually it's the debit balance. So this is a very good technique you need to know. If a closing balance is coming on the credit side, it represents debit balance and vice versa. The reason for that is because this is the closing balance of this year. Next year, it is going to be the opening balance, which will be coming on the debit side. So this is the thing you need to remember when you are actually closing your ledgers, because these closing balances will be actually put into the trial balance, which is the next step we are going to do in the next video. Now this was the exercise we did in the last lecture, and these are the double entries right in front of you. We can just quickly recall it. Ollie purchases goods for 5,000. Now purchases account debit because we are doing purchases, and pays by check, so bank account credit. Ollie makes a sale, so whenever we have a sale, sale account credit, and then the customer pays in 30 days time, that means the receivable account is going to debit. Ollie pays a telephone bill to 40 and pays by check, so telephone expense debit, and we are paying through bank, so bank account credit. Ollie receives bank interest of 150. Now we are receiving the interest in the bank's bank account debit, and interest is actually an income, so income is credit. Ollie purchases stationery. Now stationery is an expense, so stationery expense debit, and we are paying the cash for it, so cash account credit. Ollie makes a sale to the customer for 400, so sale account credit, and the customer pays in cash, so cash account debit. So these are the journal entries right in front of you. Now we also put that into the T accounts or the ledgers. Sorry. Now the next step is to close these ledgers. So now see, we only have this transaction, debit purchases. So we make the purchase account. This is the name of the account, as we discussed in the last video. And we are going to put the opposite reference because we need to know how we have done these purchases. So by looking at the purchases account, we can just realize that, okay, we have done these purchases by paying through the bank. If I write purchases over here instead, then I won't be able to understand that how we have done these purchases. So debit purchases account and credit bank. So purchase account is being debit, and we are going to give the opposite reference. Similarly, the bank account is credited, and we are going to give the reference of purchases instead, because by looking at the bank account, we can just realize that, okay, we have done the purchases worth 5,000 from the bank account. Now in the purchases account, there is only one transaction, which is the bank. So this is the only thing. We put the bigger figure on both of the sides, and then the closing balance comes over here. Now remember, this closing balance is coming on the credit side, so this represents actually a debit balance. Similarly, we have done the bank account. So 5040, these are the two transactions. So bigger side is this. We put this figure on the both sides. Now the closing balance is 4890. This is coming on the debit side. So remember, this is going to be a credit balance. That means when next time we'll open up the ledger, the opening balance will be coming on the credit side. Similarly, you see the telephone expense account. We have only one transaction, which is the bank telephone expense debit, and we have paid through the bank. So 40 on both sides. Now the closing balance is coming on the credit side. This represents the debit balance because we are going to see it opposite. Now it makes sense as well. Expense. Do you remember the mnemonic? Expense. Dead. D stands for debit, and because it's the expense, so the balance should be normally debit. Similarly, you can see the receivable account. So receivable account, where's the receivable account? Yeah, this is the transaction. Debit receivable account by 500 and credit sales. That means we have done the credit sales. So receivable account is being debited by the sale. Now this is the only transaction, so we write 500 on the both sides. And the closing balance is coming over here. This is coming on the credit side, but this represents a debit balance. Now again, this makes sense because receivable is an asset. An asset usually have the debit balances. You can come over here by looking at the interest income account. Now income usually represents the credit balance. So you see the interest income account is credited and the reference is of bank because we received this interest income into the bank. So 150 we have written on the both sides. The closing balance comes over here because here we do not have any transaction. So balancing figure comes on the debit side. So because it is coming on the debit side, actually this represents credit balance. This is the thing you need to remember, that when you are closing your ledger, the first step, again, let's look at the steps. The first step is we are going to total both the debit and credit side. And the bigger total will be posted to both ends, debit and credit. And then we'll be looking where the balancing figure is coming. That balancing figure represents the closing balance. Now, if that is coming on the debit side, that represents a credit balance. And if that is coming on the credit side, that represents a debit balance. So hopefully you have understood how to close the ledgers or the T accounts.